So we think it's important for investors to remain liquid. In fact, across the income strategy as well as other PIMCO strategies like the Total Return Fund, we've maintained a lot of liquidity or portfolio flexibility.
PIMCO Income Funds. Dan Ivison is on Consuelo Mack Wealth Track.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. What do you do for an encore if you knock the lights out running the world's largest actively managed bond fund? Well, we're about to find out. Our guest this week is Dan Ivison, the Group Chief Investment Officer of bond giant PIMCO. Ivison, who celebrated his 25th anniversary with the firm in 2023, is also lead portfolio manager of several strategies. He also manages several funds, including the PIMCO Income Fund, which he launched in 2007 and has around $147 billion in assets. PIMCO Income, rated 5-star gold by Morningstar, gained 9.3% in 2023, trouncing its multi-sector bond category and benchmark. It also far outperformed both in the 3- and 5-year periods, generating positive returns despite weathering the worst bond market ever in 2022. Its track record since inception is also outstanding, delivering nearly 7% annualized returns as of the end of the first quarter of 2024 versus a paltry 3% annualized return for the industry's benchmark. Ivison was inducted into the Fixed Income Analyst Society Hall of Fame in 2019, and he as co-portfolio manager were named Morningstar's U.S. Fixed Income Manager of the Year in 2013. This is Ivison's first appearance on Wealth Track. He doesn't do many interviews, so we are delighted he said yes to us. First question, what did he and his team get right in 2023?
2023 was a real team effort in regards to the performance of the income strategy. It was a great market environment. We had a lot of volatility in interest rates. We had a lot of volatility in credit spreads, and even a lot of volatility on a global basis. So, we had started the year in a pretty good position from an interest rate exposure perspective. We're able to get quite defensive during the sell-off over the summer months. Then the fund actually hit its highest interest rate exposure that we had taken in almost a decade, back early October, and we're able to take advantage of that fourth quarter rally. And then from a credit spread sector perspective, just a lot of individual contributions, a lot of great ideas across the investment grade space, a lot of great ideas even from our team outside the United States in terms of the positive influence of some of our global strategies as well. And all this was done over a year where we're able to increase the liquidity profile of the fund and also go up in credit quality as spreads tightened into the end of the year. So it was a good team effort, leveraging a lot of great ideas across the entire PIMCO platform.
Dan, in my introduction to you, I mentioned that the PIMCO Income Fund is the world's largest actively managed bond fund, and I'm hearing what you're saying, and I'm saying, wow, it's really actively managed. I mean, it sounds like you're trading, at least in 2023, trading all the time, taking advantage of the volatile market. So there's nothing static about what you did last year, right? You were just responding to either what was happening on the ground or actually in anticipation of what was going on. How does that work?
Yeah, that's right. So this is a very flexible strategy. We compare ourselves to other passive alternatives, but it does have a global opportunity set, and we can be quite flexible. Now, the amount of activity, the amount of shifting of positions just really depends on the market environment. So we've had prior periods where we keep a very steady asset allocation. We focus on bottoms up type ideas. We sit back and are quite patient. Last year, and we would expect on a go-forward basis, given the localized volatility across markets, given the less synchronized cycles all around the globe, that we'll likely have the opportunity to be more active. And last year, 2023, was an example of a year where there's a lot of volatility, a lot of opportunity, and we were a bit more active than usual, in particular during the fourth quarter last year, where people were quite pessimistic about inflation, quite pessimistic about central bank policy early in the fourth quarter of last year. only to become arguably too optimistic, a bit too complacent around the inflation risks by the end of the year. So it was a great example of, PIMCO coming together, a little bit of bottoms-up idea generation, a lot of top-down macro. But again, not all environments are that easy, and we really just stand poised to be active on behalf of investors if we think it's in their interest. Otherwise, we'll sit back and earn an attractive yield.
So what's changed this year? How is the market different?
This year, we'd argue was a bit of normalization thus far. I mentioned that going into year-end last year, you had witnessed a lot of really, really constructive inflation prints. You had Chair Powell quite dovish in some of his communication to markets going into last year or the end of last year. And because of that, there was a lot of optimism, a lot of anticipation of significant interest rate cuts early in the year. And we generally disagreed with that overall mindset. I think year to date, what you've seen is some weakness in bond markets, the pricing out of interest rate cuts, some more mixed inflation numbers, and now more recently, some more mixed economic numbers. I think we're back at a point now where there looks to be pretty good value in fixed income from more of a tactical perspective. Right now, if you look at forward curves in the United States, we have a couple of cuts priced in. So we went from year end where we had 6 to 8 interest rate cuts, priced in for 2024, starting very early in the year, to what we think is much more reasonable. We think that the Federal Reserve wants to cut rates. They want to and believe that they're excessively tight given the economic data they're looking at. The real question is whether the data is going to allow them to cut. But we do think that a couple of cuts in 2024 is a reasonable base case. There's plenty of uncertainty around that base case. But now we do think that a lot of that optimism regarding policy has been wrung out of the front end of yield curves. We're seeing pretty good value return.
So what are some of the major investment themes, taken from that expectation of the kind of the macro environment?
First, inflation. We've made a lot of progress on the inflation front. Inflation has come down in the United States with minimal economic weakness to date. That picture is much more mixed outside the United States, where arguably you've had more rate-sensitive economies. So there too, inflation's come down, but growth has weakened, at least on a modest basis. But we still have more work to do on the inflation front. And I think that's going to continue to be a consideration for markets, and it continues to be a focus here at PIMCO. The second point relates to the policy response. The Fed and other central banks have said they're data dependent. But again, that leads to a lot of localized volatility, a lot of localized uncertainty. So spending a lot of time, focusing on central bank policy. Then finally, geopolitics. Historically, at least in my role, have learned to do more traditional cash flow analysis, economic forecasting. But we know we live in a dangerous world, an uncertain world, conflict in the Middle East, conflict in Europe, a lot of geopolitical friction in Asia or China, U.S., and a very consequential election coming up. So that's sort of the third area of focus. I think the bottom line is that there's good value in markets, but a lot of uncertainty ahead.
So let's unpack those themes a little bit that you're talking about. So there's more work to be done on inflation. So does that mean work to be done on inflation as far as central bank policies are concerned?
We think inflation, will likely continue to trend lower. But even our forecast for the United States is that we end the year somewhere near a 3% rate for core inflation. So again, comfortably above central bank targets. We think there's a risk of the central bank needing to remain at these high policy rates for longer. We even think there's a tail scenario of maybe 10, 15% where the central bank has to take rates higher from here. So my point is that we're not out of the woods yet from an inflation perspective, but we do think valuations are more reasonable. So the bottom line is, from a longer term perspective, we see a lot of value within the fixed income markets, but a decent amount of more localized uncertainty. An important theme for PIMCO is this theme around global divergence. We do believe that some of the higher quality global markets do look quite attractive relative to the United States. They have elevated yields and far weaker underlying economic growth fundamentals. So we have been diversifying some of our interest rate exposure to areas like Australia, Canada, the United Kingdom, and even some areas of Europe. So we do really, really like the combination of higher yields weaker economic growth. We think if growth continues to remain weak over in Europe, some of those central banks are going to be able to be more flexible in cutting policy, even if growth holds up in the United States.
How much of a concern is the large amount of outstanding debt that the Treasury has and the amount that it's got to refinance in the future?
Well, we do think it's a concern, at least a long-term concern. It's highly unusual to be running the type of growth that we're running and be witnessing fiscal deficits on the order of 6 or even 7%. Again, when you look out at forecasts for the deficit, we expect those deficits to remain in that general range for several years to come. So this is unusual, and we know that when economies slow and things just happen in terms of negative shocks to economies, then deficits tend to go up from where they were during those types of scenarios. So we think it's a concern. Again, the United States has huge advantages versus other areas of the world in that we are the global reserve currency. We would expect the United States to retain that status, but the point is that as deficits remain high, there's going to be more bonds to finance. When you look at other alternatives to the United States, you see other countries around the world running more responsible fiscal policy with equally attractive yields. So what we're doing in terms of positioning portfolios is to diversify a bit away from the United States, keep our maturities a bit shorter than we would otherwise. We do think that over time, if we continue to run these types of fiscal deficits, there's going to be increased borrowing costs out the curve, and at least tail scenarios where people begin to lose confidence in the U.S. Fiscal situation. So it may not rear its ugly head for a long time, but it is a bit concerning to see these types of deficits in a period where economic growth, again, is as strong as it's currently running.
How do you figure in the geopolitical risk theme that you mentioned earlier? How do you take that concern and that fact and apply that to the investment process?
Geopolitics is a topic of far more frequent discussion at our investment committee. We just recently, completed our secular forum. We have a series of meetings throughout the year, and geopolitical issues are taking up much more of our time than they would otherwise. So that's point number one. We have a great global advisory board and a lot of great internal policy thinkers in these areas, and it's taking up a lot more of my time than it had 10 years or so ago. The second point relates to implied conviction in terms of portfolio positioning. We do focus on diversification a lot more than we would have in the past. Not only do you have to think about traditional risks, cash flows, economic growth, inflation, credit fundamentals, you need to think about unanticipated geopolitical shocks. You have to think about the impact of sanctions, the impact of other factors that could take a very solid cash flow oriented investment and create additional downside risks. I think that this type of uncertainty is going to be here to stay for an extended period of time. And again, leveraging a large platform, diversifying your sources of return, and having a healthy degree of humility around implied investment conviction is going to be important to be able to deliver returns and to be able to navigate an increasingly volatile investment environment.
And talking about uncertainty, you also mentioned the election. How much is that coming up in your investment committee meetings, and what do you do with that uncertainty?
Well, it's early, and a lot's going to change. Libby Cantrill, our excellent public policy analyst, reminds us of that, that it's a little bit early to have a high degree of confidence in forecasting the ultimate election winner. But it is going to be quite consequential. We're going to be spending a lot more time on the upcoming election, and we do think it's likely to be a volatility event for markets. So it's going to certainly matter. It's going to matter from a global perspective. It's just a bit early now to handicap it with a high degree of confidence.
How sensitive is the bond market to these different kind of risks and uncertainties? I mean, we always think of the equity market is the risk market. Well, the bond market certainly can be very risky markets as well. You've been at PIMCO for 25 years. You've been in the investment business for more than 30. Is that a big change in the bond markets, or what has changed?
Yes, the bond market is critically important. The last few years, as we know, fixed income volatility has been very, very high. Fixed income volatility has been a lot higher, at least from a historical perspective, than the type of volatility we've seen in equity markets. So we do think fixed income volatility and fixed income markets are going to matter a lot. In terms of what's changed, markets have become a lot more global. They become a lot more interconnected. And then more recently, we've gone from a period of volatility suppression by central banks, a period where interest rates were very, very low, in fact, negative in certain parts of the world, to an environment today where yields back, values back in fixed income markets, not only in the United States, but around the globe. So markets like Japan, markets like Germany, where yields were negative, outright negative for many, many years, are back offering positive yields with a lot of volatility as well. You know, over my 25-year career, things have changed a lot, but also relative to where we were for much of the last 10 or 15 years, we're at a point now where values back, fixed income markets have reawakened, and central banks are less active than they've been in the past. In fact, central banks, for the first time in a long time, have begun to reduce their balance sheets, allowing the private sector to drive value. And again, that's a very exciting time to be an active asset manager, but it's also a more volatile time. And again, I think a time where you have to take a global opportunity set into account. You have to have a healthy respect for volatility, the prospects for markets overshooting in an environment where central banks are not only less active, but actually reducing their balance sheet impact. And again, I think that creates a lot of potential for active return generation, but it's also going to lead to a bit more volatility than we grew accustomed to for much of the last decade or so.
Going back to the PIMCO Income Fund, so what is your strategy this year? And how is it going to differ from last year?
So in terms of the income strategy positioning, I mentioned that late last year, we had gotten quite defensive regarding interest rate exposure. We thought there was just too much optimism in terms of the likelihood for interest rate cuts. And yields within the fixed income market had rallied a lot, and you know, in retrospect, too much during the fourth quarter of last year. So we look at the world today, we see elevated equity valuations. We see credit spreads that probably are a bit on the tight side given the fairly extreme geopolitical uncertainty and the fact that this war on inflation hasn't been completed as of yet. So we think it's important for investors to remain liquid. In fact, across the income strategy as well as other PIMCO strategies like the Total Return Fund, we've maintained a lot of liquidity or portfolio flexibility. We also think it makes sense to go up in quality across the portfolio as well. No major concerns across the credit sectors, but again, from a relative value perspective, we see significant value in some of the high quality areas of the market, things like agency mortgages, consumer-related credit, or asset-backed securities. And as we talked about earlier, we see value in diversifying a bit into some high-quality fixed income markets around the world. So in terms of our themes so far this year, a continued focus on resiliency across the portfolio and overweight to some of the higher quality sectors of the market. Then in response to the weakness in the interest rate markets year to date, we've steadily taken our interest rate exposure higher. So again, we came into this year in the income strategy underweight interest rate risk. We still have less interest rate risk versus passive alternatives like the aggregate index, but we have added a little bit of interest rate exposure more recently. And from the standpoint of an investor thinking about a 5-year type horizon, the yield on a high quality bond portfolio is typically what you could expect. Ideally, what we try to do is generate a little bit of alpha through tactical asset allocation. And for the income strategy and other high quality bond strategies today, you can achieve a starting yield of 6, 7, 8% type levels, not take a lot of interest rate exposure. And that type of return has historically been very, very attractive versus cash, also very attractive versus equities, and particularly attractive versus equities when you look at pretty lofty or elevated valuations across the equity markets today. So we're optimistic in terms of the income that we can generate, optimistic about the ability to add return in a volatile, less synchronized global economy. But we do think it makes sense for investors to maintain flexibility and also to go up in credit quality a little bit. We do think there's a little bit of complacency in segments of the equity market, a little bit of complacency in some of the more economically sensitive areas of the credit opportunity set, particularly some of the floating rate credit sectors that are feeling the full brunt of central bank policy.
So how should we look at bonds in our portfolio now? And let's just be specific, the PIMCO Income Fund, what role does a PIMCO Income Fund have in a long-term diversified portfolio?
Yields were quite low across the global fixed income markets going into this COVID period. And then 2022 was a very rough environment for fixed income investors, actually nearly all investors. So, it's been a rough time. But again, in some sense, the weakness in fixed income markets was a prerequisite for value to return in this space. So I think the most important theme for an income-oriented investor, for an income fund investor, is just to realize that, yes, it's been painful repricing rates from near zero to where we are today, but on a go-forward basis now in the higher quality segment of the market, you can generate 6, 7, 8% type returns. A great predictor of future returns in the fixed income markets is the starting yield. In fact, our market's a lot easier to analyze in that respect than a lot of other segments of the financial markets. So for an patient investor, sure, there's going to be volatility, there's going to be central bank uncertainty, there's going to be periods like the fourth quarter of last year where bonds rally a lot, or periods like the first quarter of 2024 where bonds sell off to some degree. But if you sit back, earn your income, make some thoughtful tactical asset allocation decisions along the way, you're in a situation today where you can generate very, very attractive yields, very, very attractive returns relative to many, many other areas of the financial market opportunity set. It's been a first time, and this has been the first time in many, many years where you can say that. So I think you can sense a lot of confidence in my voice here in terms of fixed income returns for the patient investor. Yeah, there's going to be lots of zigs and zags, a lot of volatility to ideally take advantage of if you're well positioned. But valuation is the most attractive it's been in a long time. And again, it's something that we're quite excited about.
If there's one investment for a long-term diversified portfolio that we should all own some of, I ask every guest this, what would it be?
We're excited about high-quality fixed income, and I think that investors have a lot less of it than they should. A high-quality bond portfolio today, generating a 7 or an 8% type yield, we think has a high likelihood of out-earning cash, and under many scenarios has a high likelihood of outperforming equities as well, especially on a risk-adjusted basis.
One of the many areas that you oversee are the total return strategies at PIMCO. In late 2022, you joined the PIMCO Total Return Fund. How does what you're doing at Total Return differ from what you're doing at the PIMCO Income strategy?
The Total Return Fund continues to be critically important for our investors and therefore critically important to our firm. Total Return Fund is a more benchmark-oriented strategy. We look at the aggregate index and we look to generate attractive returns relative to that passive alternative. And I did join that team in late 2022 to work with Mohit Mittal and other talented investors in that group. And again, a lot of the themes that we talked about today regarding high conviction positioning is reflected in that strategy as well. So it's a high quality fixed income product tied more to that very, very important fixed income benchmark, but similar flexibility in terms of approach relative to that benchmark, global opportunity set. And again, it's been great to be part of that team, and we've been very pleased and proud of the performance that we've been able to deliver over the course of the last couple of years.
Dan Ivascyn, thank you so much for joining us on Wealth Track. We really appreciate your time. And also congratulations again on how well the PIMCO Income Fund has done and is doing. Thanks, Dan.
Thank you very much, Consuelo. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider adding Treasury inflation-protected securities, or TIPS, to your portfolio. TIPS are U.S. Treasury bonds indexed to inflation. They are liquid, meaning they are easily bought and sold. You can buy them directly from the government in varying maturities at treasurydirect.gov or through well-established funds. One highly rated passive choice for short-term maturities is the Vanguard Short-Term Inflation-Protected Securities ETF. There is also the longer-term actively managed Vanguard Inflation Protected Securities Fund. Another well-respected choice is the iShares TIPS Bond ETF. Christine Benz recently recommended the iShares iBonds Term TIPS ETF, which holds a portfolio of TIPS that mature in a specific year. They are available in different maturities. She suggests buying them in increments to build a bond ladder for retirement. Inflation is a fact of life. Even if the Federal Reserve is ultimately successful in bringing U.S. inflation down to 2%, price increases still erode your purchasing power and value of savings. Having some inflation protection guaranteed by the U.S. government is one way to keep up. Next week, leading economist Nancy Lazare discusses the state of Middle America, still her favorite emerging market, and why it and the economy as a whole are under pressure. In this week's extra feature, Dan Iveson shares how he de-stresses from running the world's largest actively managed bond fund. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a wonderful Mother's Day, and make the week ahead a healthy, profitable, and productive one.